Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding members of the Dividend Kings marketplace site on Seeking Alpha. As I'm writing articles and reading comments and talking to investors, I'm finding a lot of people today seem to be really concerned about a possibility of a recession coming. Politics plays a big role in that, the tariffs. People seem to be very heavily concerned about interest rates. So I thought it'd be interesting to do kind of a quick little study and look at markets and interest rates and politics and how these things really interact with each other. Because it's my opinion that although all the things that I just mentioned do have, impacts on stocks and valuations and prices, they're just one of many factors that really determine whether or not you'll do well as an investor in a common stock or not. Because I always say it's a market of stocks and not a stock market. But anyway, what I've done here is I've created a little screenshot of the fast graph using the S&P 500. And I want to just go over this a little bit. What I've done is I've put time frames here. I only go back to 2000, so I only included a year or so of the Clinton administration. I included all of the Bush administration, all of the Obama administration, and all of the Trump administration so far. So the first thing I want to basically say here is that stock prices basically rose throughout all these various political environments, whether it was Democrats or Republicans. The stock market actually generally rose. Now, coming into the end of the Clinton administration, the beginning of the Bush administration, we had very, very high stock market valuations. And then we also went into the 2001 recession where we saw earnings of the S&P 500 drop by about 30%. Then for the next 4 or 5 years of the Bush administration, we saw good earnings growth and good stock market activity. And then as we came into '07, we start seeing a little weakness in the economy. And then, of course, we were in the throes of the Great Recession throughout 2008 and the better part of 2009. Now, a couple of things. These are the only two recessions we've had since 2000. This one lasted 8 or 9 months or so. The Great Recession lasted about 14 months. And we did have falling stock prices during both of these recessions, but they're not the same. I want to emphasize that valuations were actually reasonable coming into the Great Recession, and stock prices simply followed earnings down. In the 2001 recession, we actually had very, very high valuations, and stock price never even fell down to fair value, but we had a very precipitous drop in the S&P 500 over this time frame. And of course, that also had an effect on the long-term results from that time. Now, coming into the Obama administration, where the recession was just, kind of on its last legs, we saw stock prices track earnings very, very nicely during this time frame. Then we saw valuations begin to get extended in the last 3 years of the Obama administration, and they've been very high during the Trump administration, but we did have a pretty bad or pretty weak 2018, as you can see here, where the price went from, here to here, and now we're back to overvalued territory again. Now, all of this occurred under all of these different political environments. That's the only point I'm making here, that politics play a role, but they are not the primary driver of what stocks will do or even what the economy will do in the long run, at least in my opinion. Now, I'm going to move to a live fast graph here, and I want you to keep the politics that I showed previously or a second ago in mind here. And I want to make sure you understand what happened in 2000. We had very, very high market valuations, PEs 26, 27, 28. And then we got down to PEs in the 17, 18, 15, 16 range, which is much more normal. And then we saw PE ratios being relatively normal again in the 15 range. And now once again, we've seen these high valuations. So valuation is a really big factor in what happens to companies over time. So let's look at the PE versus interest rate cycle during this time frame, because when I'm looking at this graph here, what I really want you to understand is what theoretically should happen. This burgundy area is the 10-year Treasury bond, and you can see what it is over these different time frames. Of course, we went from a 6.6 or 7% 10-year Treasury note to currently about a 1.55%, or at least as of July 31st, that was the rate of the 10-year Treasury. So what we've generally seen here is falling interest rates. Now, in theory, what should happen when interest rates are falling, we should see stock valuations rising. So this blue line is year-end PE ratios here for the market. So what we're seeing here is that we actually saw PE ratios of the market shrinking in tandem or simultaneously as interest rates fell. It should be the exact opposite. PE ratios should be rising like we saw here as interest rates are falling. But if we go back to the historical graph, what we see, ruined that conventional wisdom was the fact that we had such high valuations here that there was almost nowhere for stock prices to go or valuations to go but down. But not only that, we also had a big recession in there. We had a period of very, very weak earnings. So although these theories are fine in general terms, the point is that interest rates and PE ratios don't always move exactly like everybody expects them. So next, let's go ahead and look at one of the highest quality blue chip dividend growth stocks on the planet. Of course, I'm referring here to Johnson & Johnson, and look how it performed during these different environments. Remember, I've got the Clinton, the Bush administration, the Obama, and then the Trump administration that we're going through here. The first thing I want you to notice is if I get rid of stock price on this graph, that Johnson & Johnson did extremely well. It's a very consistent grower, and it did it through all these various different political environments. I also want to point out that it did it through all these interest rate environments. The company was able to grow its business at about 9% a year throughout all these different interest rate cycles as well as these different political environments that they found in. Now, once again, when you bring price into the equation and look at valuation, what you see is very high valuation. And high valuation, for those of you who are just new to my work here, would be when the price is above this intrinsic value line here. The orange line is an earnings justified valuation line. And you can see valuations were high, and so we had very flat stock prices. During the recession, Johnson & Johnson actually was fairly valued, more or less, because there's always volatility with stock prices. It did drop in value during the recession, but quickly recovered. But I do want you to notice the company's earnings grew throughout the recession, and their dividend was increased each year during the recession. Then once we came out of the recession, earnings continued to go, stock price advanced. We had overvaluation, reverting back to the mean, a couple years of overvaluation, reverting back to the mean. And then last year we had, at the end of last year, we had Johnson & Johnson's stock price being moderately overvalued again, but now we're back into what I would call fair value territory for Johnson & Johnson, and you could buy it with almost a 3% yield today. So the point is that operating results and valuation are not just directly tied into interest rates or the politics. When I look at Johnson & Johnson and interest rates, we see valuation falling dramatically as interest rates trended down. And again, that had to do with the Great Recession that we saw here, that had to do with the overvaluation that we saw back here. Those things actually had more impact and more of effect on Johnson & Johnson shareholder returns than politics, interest rates, or other macroeconomic environmental factors that we all worry about. And that even includes recessions that we saw. Because once again, if we go back to this graph, Johnson & Johnson's stock price actually performed extremely well during the 2001 recession and actually performed better than most stocks during the 2008 recession. Now, the next example I looked at was General Electric, a kind of a troubled business, a company that's had all kinds of operating issues. Now, it had an extremely high valuation coming into the 2001 recession, as you can see, and you saw this enormous reversion to the mean. And this was during a time when price was much higher than earnings justified. Then we saw it kind of, sort of tracking earnings here a little bit as we came into the 2000 recession. But keep in mind, the company had become a financial services company. It literally morphed from being a major appliance manufacturer to a very prominent financial company. As a result of participating in all the financial excess that went on, as the recession came in, you can see that General Electric had a significant destruction of shareholder value during the Great Recession. The valuation of General Electric actually fell by over 79% from a standpoint of just pure price. They were paying dividends, but I also want you to notice they cut their dividend. And then I want you to notice that they did pretty well coming out of the recession for the first couple of years. But then more recently, the stock was very vulnerable. It was very highly valued. They cut the dividend. Earnings began to fall. They virtually all but eliminated the dividend. And of course, once again, we see very, very poor performance. But keep in mind, this is through all these different political environments that we talked about. And it's also, as we'll take a look now, it's also over these different interest rate environments. And in the case of General Electric, we see interest rates precipitously dropping, just like we did with Johnson & Johnson or the market, same time frame. But we also see valuations going down in tandem with interest rates. So the point is, there really was no functional relationship here. In other words, it's just simply a coincidence that we saw a drop in valuation during a period of dropping interest rates. What we really saw was a deterioration of a business over this time frame that wasn't able to perform like Johnson & Johnson was able to perform in these different political environments, but it had to do with how the business was being run, the decisions management was making, not interest rates, recessions, or politics. It's Simon Property Group, and take a look at it from a standpoint. Here I've switched the funds from operations, which is the metric you utilize when you're looking at REITs. But the reason I'm showing this high quality REIT is because, once again, there's a conventional notion out there that says REITs are very, very sensitive to interest rates. But if we look at the Simon Group here, we see that the business grew FFO very nicely. They had a little bit of stress during the Great Recession, but they actually performed pretty well. They did reduce their dividend during the Great Recession. They did cut it twice, but then since that time they've increased it again. But once again, we see that things like very high valuation had much more of an impact on shareholder returns than politics or interest rates. But we also see low valuations, even going from low valuation to low valuation, generated almost a 20% rate of return here. If I'd go from the trough to the peak here, you could have made 33% annual. These are annualized rates of return, not 33%, almost 630% gross, over 700% gross returns, actually counting dividends. What you're seeing here is a 33% annualized rate of return. But the point is it's a market of stocks, not a stock market. And the valuation of the business you're looking at, the operating history of the business you're looking at, is much, much more important than interest rates. When you look at how this company performed, we actually do see what conventional wisdom would suggest. We saw interest rates dropping and the valuation of Simon Group rising up through 2005. But then as we start hitting the recession, we saw a precipitous drop in interest rates, and we actually saw the valuation of Simon Property Group drop. Once again, you look at it, it was moderate, it was pretty overvalued coming into the Great Recession in 2007, and then of course it became very undervalued. But again, that was really independent of what interest rates were doing, not because interest rates. In theory, valuations should have been going up as the interest rates were dropping there. Then for more recent years, at least since 2009, after the Great Recession was over, we saw the valuation of Simon falling precipitously as interest rates continued to drop. And what does that mean? That simply once again tells me that valuation was the culprit here. The stock was significantly overvalued. And now, with all this fear of interest rates and politics coming up in 2020 and all the other things that people tend to worry about, we did see this significant correction. And now we've got Simon sitting at a very undervalued level. But there are so many different factors that affect how a business is going to do. Let's take a look at just a couple of examples. What I'm really going to do here, I'm going to close by just pointing out, it's not interest rates, it's about how well a company's managed. Here's a company that you just can't, I don't even know how you could ever forecast the stock like this. There are so many different kind of companies. Here's, a company in the retail clothing business. If you look at situations like this, it should become very clear to you that stocks are not all the same. They perform totally differently. Look at how earnings and market price factor in here. I want to end this by simply saying this. It's not that politics and interest rates and things like that aren't factors, but if you're investing in really great businesses and you're buying these businesses because you like the company, like the management, and like the history, you're also saying that you trust the management to be able to navigate. To me, things like, how can government affect us? If they raise taxes, that's obviously going to increase the expense of doing business. If taxes are lowered, that's going to free the companies up. There's more regulation, it's going to be harder to operate than if there's less regulation. But the point is, you are looking for good management teams and quality businesses that can prosper and grow through any of those types of environments. So, you can't be overgeneralized. That is a form of prejudice. All stocks are not the same, as I illustrated with this video. So anyway, I hope you get some better perspective on things like recessions and interest rates and politics as it relates to your investing. As I said in the article in the written portion, mind your own businesses. In other words, pay attention to what you actually are invested in and quit worrying about the overall market and quit worrying about politics and everything else. Focus on what the relative valuations and the earnings prospects and the business prospects of each of your businesses are, and you're going to simplify your investing life. You're going to be a lot more comfortable. You're going to sleep better at night and be able to make better long-term decisions. At least that's been my experience. So I hope you've enjoyed this video. If you like what you saw, don't forget to hit our subscribe button below. Thanks again for watching.